Hey there, this is Andy from Two Gray Beards, and today I'm going to do another explainer. This one I'm going to call What's Going On with Banks? So, the current situation with banks must be confusing for many of you. I personally find much of what I read conflating many relevant issues facing banks into one hard to unravel mess. Each day via videos like the explainer I did on deposits and the explainer we did on the SIVB situation. I attempt to interact with you, and via threads and Twitter feeds, I interact with other smart people, and I run into the same issue again and again. I'm not sure what the problem is. It may be due to those conflating the issues having some lack of understanding of how it all fits together, which is completely natural. This is not easy by any stretch of the imagination, or they just want to end up with a synthesis that fits their worldview. I think what's useful is to speak to you about how I break down what's going on so you can do the same and understand the arguments that smart people are making. I may be wrong in my breakdown, and please give me feedback on this video or on any Twitter feeds that you see this video posted. I'd love to help. So I see banks today, and frankly, all throughout the history of our current century-old monetary system, exposed to two primary issues. It's the same all the time. One is the bank solvent? That seems like a big deal. Two, is the bank going to remain solvent, profitable, expanding over time? So, my first breakdown when I think about banks is to ask, are we discussing current solvency or future solvency and profitability? Okay, that seems like a pretty basic breakdown. I don't think there are options. We're either discussing today or we're discussing the future. So basically, that's where I start. And just this one question is incredibly important. If someone can't answer this question, it's likely that the discussion will go nowhere useful. Now, if you get an answer to this question, great. The discussion can now proceed on a logical path. If the answer is about immediate solvency, we can have a good discussion. So, for instance, and I'll answer some of these questions at the end. One relevant question, critical question, when you're talking about solvency is what are the assets, loans, bonds on the balance sheet of a bank worth? That's a fairly important question. And some banks hedge, some banks don't hedge, and it's not trivial to find out what the assets of a bank are worth, but conceptually, it's an essential question. So if you're talking with somebody and they're talking about bank solvency, and you've gotten them to talk about bank solvency, not bank future, great. Now ask them what they think the value of the assets are. Now, the next step is that the value of the assets has to relate to the claims on those assets. And the claims on those assets, just like any balance sheet, are the liabilities and the shareholder equity. That's who owns a bank. Its liability holders and its shareholders. Now, in each case, you can have preferred shareholders and equity shareholder, common shareholders. You can have corporate bonds and CDs and demand deposits, which are your ordinary deposit. But most of the case that we're dealing with now you can consider the liabilities to be the deposits. And so if you know the answer to those two questions, you know whether the bank is solvent or not. And so from there, you can, you have the answer to that discussion. Is this bank solvent? Now, let's assume that if a bank isn't insolvent after these two questions are answered, it will likely fail. There's some interesting paths if a bank is close to insolvent or insolvent, though. And so some questions might include, this one seems like a bit of blame seeking, but also very important to understand the assets. And that is, why did the assets fall in the first place so that the bank's insolvent? What happened? Okay. Now, a very important question is, should depositors rapidly withdraw their money from insolvent banks? And again, I'm going to come back to all these questions, but the important part is what I'm trying to give you here isn't what I think about the banks. It's what will help you evaluate the words that are being said by people you're listening to in terms of whether they make logical sense, and then to ask them good questions so you can get answers that stay logical instead of conflating all these into one outlook. Okay, so what other questions might you ask a bank that's insolvent or on the verge of insolvency? And I guess that would be, what could change? Like, overall market prices of the assets held by the bank were the reason why the falling of those assets were the reason why the bank is insolvent or close to insolvency. And so, one of the important questions, particularly in our very activist policymaker world that has happened going back to, well, for a long time, but in particular in the great financial crisis when TARP and other lending programs were established, the when the fiscal side created bailouts of various industries, and that was, done again in the COVID crisis. So policymakers have been fairly active in intervening in the markets to avoid, cataclysmic results. Now, who knows what would have happened if they hadn't intervened? We'll never know, but we know they have. And so seems like a fairly obvious question is, well, these assets have fallen. What policymaker levers can be pulled and would have an effect of causing these assets, these long-term bonds, loans, to improve in price so the bank is no longer insolvent or is no longer on the verge of insolvency? So that's an important question. What levers could policymakers pull effectively to make these assets more valuable? So another question, which is important and is really what's happened to the three banks have been closed. And so those are different situations now. But there are a number of other banks that are currently using programs offered by the Federal Reserve to help banks that are on the verge of insolvency or insolvent to meet deposit runs, where the depositor, as I said, one of the important questions is, should I leave an insolvent bank? Well, some people are, and that's causing stress to banks that are close to insolvency. And so the question I would ask about insolvency is, how do the Federal Reserve lending programs provide solvent or insolvent banks time to meet a deposit run and perhaps survive? Now, if you remember my original framing of this conversation, I wanted to break down the question into, are we talking about banks now or banks futures? So the last question brings us back to the original question, because it deals with whether the bank is going to remain solvent in the future when it uses these federal programs to buy it some time. Okay, so now we're going to focus on that question. In order to discuss a bank's future solvency or better its future earnings, one can ask many questions. And these are the ones I think are important. The first one that matters, which I didn't even mention when discussing immediate solvency, while I would say that that is almost by almost, well, there are really two, really the majority of points that people make when they're talking about banks and conflating solvency with future. And that is, given current interests offered by money market funds, brokerage accounts, treasury bills, and even other banks, how will a bank retain its deposits and at what cost to future profitability and solvency? Another smaller but related question. Given banks that were close to insolvent and saw a deposit run and are now using high cost federal lending programs instead of lower cost deposits, can a bank remain solvent at that higher cost? So that's the ones that are using the programs already have lost their low cost deposits and are now paying high cost, about as high as you can pay for to their liability holders, which are essentially the Federal Reserve. And that high cost has an immediate impact. Now, not an instantaneous impact because interest is paid over time, little bit by little bit every day. It's a drip. It's not a waterfall. Okay, so what other questions? So this is a very important point that is not mentioned that often, which is as the bank costs of deposits go up, what's happening to the interest rates paid on any new loans or bonds put on the balance sheet when old loans or bonds are paid off or mature? That's a very important question because those new loans are replacing low earning old loans with high earning new loans. Okay, this is where you bring it together. I see how costs of deposits are rising rapidly, and that is a pressure. And I see how new loans that replace old maturities cause interest income to rise. How does that play out over time? Okay, the follow-up question on that, once time has played out, can banks operate profitably at any level of interest rates, at any level of the yield curve? That's a fairly important question because one might think, given some things that are written today, that every time interest rates rise, all the banks in the world fail, and that doesn't happen. So what's going on? And so that's the follow-up question to the rising interest rates resulting in some pressure on um, deposits to go up, meaning the cost of a bank going up, while at the same time, new loans and bond purchases also have higher revenue to the bank. So this comes back to, risks, this next question. And so existing assets on the bank's balance sheet continue to fluctuate every day. What risks do the banks have, and can they reduce their risks to these fluctuations? That's an important question. They don't have to sit around with the same risk. They can shift. Important action step of how banks can behave. So In this crisis, this is the next question. In this crisis, the rapid rise in long-term interest rates caused loans and bond prices to fall, and risks of insolvency increased. Why did long-term interest rates rise? Seems like a very important question. Some believe that the reason why long-term interest rates rose is because short-term interest rates rose. I don't. I think there are other causes to that, but it's worth exploring with whomever you're discussing this issue with because it has significant implications. Another question, in the GFC, borrowers from banks, which are the loans on banks' balance sheet, were unable to pay back their loans, and banks became insolvent as as the value of their assets fell because people weren't paying anyone back. Is that what's happening today? Is it? Are we in a great financial crisis where credit is the driver of banks' assets falling? Well, a follow-up question gives you the answer. Given today is not like the GFC, and the loans are money good and not falling due to credit risk, but are falling due to rising long-term interest rates, what levers are best for policymakers to pull in order to help those bank assets? Okay, that's an important question, worth asking, because currently the market, when bank crisis intensity increases, has priced in Fed rate cuts as the response to not only this, but partly in response to the view that cutting interest rates would be what solves the bank's crisis. It's an important distinction. Now, we'll come back to that in the answer section. And by the way, my answers aren't going to necessarily be right. No, last, it's something that's worth talking about because there's quite a bit of chatter about it that has nothing to do with insolvency at the moment and may not actually be a factor ever. Could be a factor, not saying it won't be a factor. In fact, there's a fair chance it will be a factor, but it's not today. I hear a lot of people discussing CRE loans. Are office building loans causing banks to fail today? Is that a clear and present danger to banks today? Or is that something that may become a risk, but isn't causing the current crisis? So I'll answer that first. CRE has nothing to do with what's happening today and is a risk. And I don't know how it's going to play out, but you should pay attention to it because it does impact the value of bank assets. So anyway, stepping back, as you can see by breaking down the current situation into immediate solvency related questions and future solvency and profitability issues, you can ask the right questions. I hope this helps. You can stop here if you want. Otherwise, I'm going to go back up to the top and answer these questions based on what I think. And this is just one man's opinion. Could be wrong. Probably is. Okay, so question number one. I'm going to deal with, is the bank solvent or insolvent? So I would say that there were two banks were insolvent. Silicon Valley Bank, insolvent. Signature Bank, insolvent. Bank run occurred. End of those banks were seized before the Fed even introduced any temporary measures to offset the deposit run. That one's done. First Republic Bank is an interesting case. This is a bank that got acquired by JP Morgan, and JP Morgan got the assets at lower than what they were worth relative to the liabilities, the deposits. And the FDIC coughed up $11 billion. So technically, it got seized and was insolvent and was then sold. Now, the question becomes, was there some sort of reflexivity that was driven by market participants pushing on the stock, causing more deposit runs, causing more concern, such that the buyer, JP Morgan, and the other people that bid knew that the players involved, including the FDIC, the bank management, the deposit, the treasury, everyone involved in overseeing this particular transaction had to have it happen. It's not a great, it's more of a buyer's market than a seller's market. So I'm going to say probably insolvent, but it's close. Whereas the other two, insolvent. So then you have to look at all the other banks, and which include, thousands and thousands of banks that are less big than the three that have already tumbled, almost by definition. And some of them are going to be insolvent. My view is some of them are going to be insolvent. Less size. If I had to bet, put a gun to my head, there are going to be the total asset value of all future, and future meaning this year, bank insolvencies will be lower than the combined value of the three that already became insolvent. So less than half the prior problem, and spread over many times many times three. So is it 18 or is it 30 or is it 60? Not sure. But the quantity of assets, I suspect, will be less than the sum of the three. Now, we'll come back to is the bank going to remain solvent over time? So, and I discussed how I'd evaluate a bank, its solvency or not. My judgment is that most banks are solvent, and most banks have plenty of liquidity and will be able to any deposit flight. Well, there won't be deposit flight, but any deposit flight will be minimal. In addition, I expect once the debt ceiling is resolved, because there's politics involved, there will be FDIC reform. That's a different topic for another day. Okay, so my next question was, why did assets fall in price so the bank is insolvent? And the answer is long-term interest rates went up. That's it. Should depositors withdraw their money from insolvent banks? Well, the answer to that is, if it's insured, probably not. If it's uninsured, turns out probably not, but I wouldn't take that risk. So, what would change in overall market prices of assets held by the banks such that they would return to solvency? And what levers could policymakers use to cause that change in market prices? Now, this crisis is about interest rates long-term interest rates rising. That the solvency crisis is about long-term interest rates rising. So long-term interest rates have to fall. What drives long-term interest rates? Inflation and growth. The best way to cause the bank's assets to improve in price is to cause a recession, a deflationary recession. How do you do that? You keep rates higher for longer, or you keep rates high enough to be restrictive for long enough to kill inflation and also cause weakening growth. That's why bonds rally. They don't rally. In fact, they fall, like we've seen them fall, when inflation stays high and growth stays high. What causes inflation and growth to stay high? Cutting interest rates. So the lever of cutting interest rates is exactly the opposite, in this case, than what you would want to improve banks' assets. However, They cut interest rates in the great financial crisis. Why? Well, it's when a private person who has gotten borrowed from the bank and has a loan, for them to pay it back, which was the problem in the great financial crisis, it had nothing to do with the level of interest rates. It had to do with people not paying the bank back their loans. So how do you get people more money so that they can pay back the loans? Well, you do what the Fed did. You lower interest rates, which stimulates growth and inflation. Inflation means the houses go up in price, the wages go up in value. Growth means that people pay more for stuff and they want more stuff. That's how you improve a credit crisis. That is not how you improve an interest rate crisis. Okay. Okay. So now let's talk about bank walks. So we're on to the separate section when we're only discussing the increase in short-term alternatives to deposits and what that means to bank profitability. Instantaneously, it won't change solvency at all. It changes solvency over time because, it's just like, if you're a lemonade stand and the price of lemons went up and you can't push prices on to your distributor for your lemonade or your customer for your lemonade because you have a 5-year contract for selling them lemonade. Well, you're going to see your profitability and potentially your solvency decline. So it hurts profitability if you have long-term asset returns, like a contract to sell lemonade at a fixed price or a loan at a fixed interest rate. If the price of lemons or the price of deposits goes up, your profitability gets squeezed, which could lead to your solvency getting squeezed. You could be put out of business. But it takes time. Now, the thing about that is that given banks that were close to insolvent and saw a deposit run are now using. Okay, so now let's talk about the other side. Every day, one of your lemonade stand contracts or loans ends, and you can raise prices on the next loan or next contract to sell lemonade. And so higher interest rates actually result in higher coupon income from new loans that you make as a bank. And so that's happening every day. Now, the question is, which comes first? Well, that's management. So you want to see a bank manager do an excellent job in minimizing through time their cost of deposits, meaning their costs, while retaining adequate deposits to meet the need for their for lending, while also, when interest rates are very, very low, not buying a lot of loans, bonds, and when interest rates are very, very high, buying a ton. And so that's a skill. And, you just have to recognize that. And so the path will be different. The insolvent banks that are borrowing at the Fed program rates, their cost went up instantaneously. JP Morgan's cost, that's going to take a long, long time before they pay a lot of interest. While at the same time, they're the place to get a loan right now, and so they can replace old loans with new loans at high interest. So that's, that'll differentiate one bank from the other. Okay, so, the next question I think is relevant is, yeah, so I think that covers pretty much all of the questions I asked, and I'd ask, you don't ask me, I gave you my answers. Ask everybody else, break them down. Are you dealing with solvency today? or are you dealing with long-term profitability? Solvency is straightforward. Are the assets going to cover the liabilities, and is there anything that policymakers can do to buy time? And forward-looking, it's how can you improve your revenues in higher interest rate environments while minimizing your costs in higher interest rate environments and keeping adequate deposits so that you can, meet all your needs for funding without having to go to expensive government programs. And lastly, credit risk is always a risk. It was the risk in the GFC. It is not the risk today. And I guarantee you it will be a risk again. Will it be CRE? Who knows? I hope this was useful. Have a great day.